It is largely to do with the massive size of the US life insurance market. They pay out, I think it's $2 billion a day in death claims. It is absolutely enormous. There's 700 life insurance companies or more in the US, and also a lot more individuals. I think there's a much greater tradition of taking out life insurance in the US.
Well, welcome back to the hot seat. Today, I'm delighted to be joined by Christiaan van Hout from Vie International. Welcome, Christiaan.
Thank you, David. Nice to be here.
So we're going to get into a little discussion today about US life insurance. But just to kick off, it'd be great to hear a little bit more about you and what you do at Vie.
Sure. So I've been with Vie for 5 years. I'm a financial advisor and independent life insurance broker. We provide retirement solutions, life insurance solutions, typically for US clients, most of them in the UK, some elsewhere. And my focus is on providing life insurance solutions.
Okay, great. And for those not familiar with the US-UK compliant life solutions, perhaps we could open our conversation with a little description of why that is useful to clients and the sort of context in which you see it being used.
Sure. So the US market, if someone's a US taxpayer, they would always be wanting to, as with all of their financial plans, have a US compliant sort of arrangement. So they would always be looking to take out a US policy in a way that is also compliant for UK purposes. It's also worth non-Americans knowing that they may also be able to access the US market. And the reasons why they might do that, I'll run through them very, very briefly, but one is cost, particularly on the permanent insurance solutions of the sort of whole of life. You can be looking from 20 to 40 or even 50% discounts in the US versus the UK. Underwriting, not always, but typically medical underwriting can be a bit more favorable in the US. Things like if you disclose that you're a cigar smoker in the US, you'll get non-smoker rates. In the UK, that might increase your premium almost double as a smoker. There's more flexible financial underwriting. So and sort of premium payment arrangements in the UK, you might be limited to monthly or annual premiums. In the US, there's a lot more flexibility. You could say, I want to prorate my premium, so I've stopped by my retirement age at 65. It might be you might have a business owner or a PE executive who has a big liquidity moment in 5 years and wants to pay up their policy at that point. You can continually sort of change how you fund policies in the US market, and that can obviously suit clients' circumstances, that type of flexibility.
So is the reason on the discount side, on the price, just a function of the size of the US insurance market, or what drives that discount available on the premium?
Yeah. No, good question. It is largely to do with the massive size of the US life insurance market. They pay out, I think it's $2 billion a day in death claims. It is absolutely enormous. There's 700 life insurance companies or more in the US, and also a lot more individuals. I think there's a much greater tradition of taking out life insurance in the US, both term and sort of permanent policies. Very, very favorable tax rules in the US, whereas over here, I think it used to traditionally be sort of clever trust planning you could do with lawyers and trustees in the UK. And life insurance wasn't always sort of at the forefront of planning where it has been in the US. It's not uncommon when we get introduced to clients, if they're in their 50s, they'll have an investment portfolio and a life insurance portfolio.
And what are some of the market trends? I mean, how has COVID impacted, pricing, mortality awareness? Is it driving tax planning? What have you seen in terms of COVID impacting both the insurance market and the policy holders or people motivated to do some planning?
Sure. Initially, there was, as probably with a lot of professionals, our business sort of halted temporarily as everyone was trying to reassess what it meant and sort of how they could continue to deliver services. But the reality is it's largely rebounded. So capacity in the market is pretty much back to where it was pre-pandemic era. We're back to having, just one insurance company in the US can issue $65 million of insurance without, on their own books. So we're sort of back to those types of levels. There have been some changes in pricing over the last year and a half, but the funny thing is that's not so much driven by COVID, because that actually doesn't really worry insurance companies anymore. Now that they've seen the mortality data that comes from that, it's actually the sustained low interest rate environment. So the insurance companies have just found it extremely difficult to make money off of these permanent products with very, very long-term guarantees, and they're restricted in being able to invest their own assets or the premium pound or premium dollar assets in extremely safe investments, which then don't yield very much. So as a result, particularly on the permanent products, the whole of life, essentially, we've seen sort of a pattern of just incremental price increases over the last couple of years. Particularly short-term products, have actually seen the price starting to come back down again.
How much weighting do you find people put on the guaranteed premium products in terms of just knowing if it's a 10-year term policy with a guaranteed premium versus the whole of life products with potential kind of escalation in the premium that shouldn't be a surprise but may come as a surprise? Do you find the term products are interesting for the certainty that it provides around the premium?
Sure. We don't ever put in place permanent products or whole of life products that do not have a guaranteed fixed premium. So most of our policies are from the US market, and they are guaranteed. They're fixed. The policies that we would look at. So there is reassurance that the insurance company can't review.
Terrific. And what about non-Americans accessing the US market, and why would they want to do that?
Sorry, my connection just goes a little bit.
I'll just come again with that question, not a problem. And what about non-Americans accessing the US market? You mentioned the discount on pricing, the variety of products, but why would a non-American want to use a US policy?
Sure. So
I think you just froze there a little bit. Should we just?
My connection's freezing a little bit.
That's all right. Let's just give it a sec.
So I heard the question and then it just froze. So should I just?
That's fine. It's a short question, so I'll just. So we heard of some of the benefits of the US market in terms of the number of life offices, the discount on premiums, and why would a non-American want to access the US market on top of these kind of considerations?
Sure. So the US market being so large, the insurance companies are quite commercially minded. They want to do business, that they just have more favorable rules and practices, assuming you can demonstrate some sort of nexus to the US in the first place. So not anyone can access the US market, but if you have investments in the US, real estate, property, you have earnings in the US or US company, or US employer, the one that everyone has, if they say, no, I have absolutely no connection to the US, and you start peeling back the layers and they say, well, I do have this investment portfolio and it's globally balanced, and yes, it includes some US equities. Sort of hold on, US equity is a citus asset for US federal state tax purpose. So then if you can demonstrate that to a US life company, they will see that as a legitimate financial interest in the US, and they would typically accept you. Why? So some examples, if a couple of things come to mind, there's less strict sort of insurable interest rules compared to the UK market. So in the UK, you might typically you would only be justified in taking out an amount of insurance commensurate with your UK situs assets. So you might have a client who has, let's say, £10 million home, but £100 million of assets globally. They would only typically be eligible for £4 million of cover in the UK based on that UK asset. In the US, they don't restrict themselves to that. There is no requirement to limit the amount of insurance on US assets. They would look at your total global estate, and that would include assets and offshore entities like trusts, companies. And so it just helps enable more options when you're discussing sort of succession planning with clients with a lot of sort of overseas and offshore wealth and offshore entities. Another one is residence. So this is just a very practical point, but in the UK, they typically require UK residents to be qualified to take out a UK policy. There are some companies which are trying to be a bit more flexible here, but that's not really developed programs, and there are lots of caveats. The US does not demand US residents. They're very much aware that there's more wealth outside of the US than there is inside the US, and they want to capture some of that. So they were able to insure many sort of residents of other countries worldwide, and exams can be done over here. And that's a sort of a good amount of our business. We've had one banker in the UK who had a South African British client resident in Italy under their non-dom regime, needing life insurance, and the bank who does UK life insurance couldn't adequately sort of service that or make arrangements. So they sort of came to us, and we then went to the US market and were able to place a case for her.
Are these policies often held in trust? I mean, in the UK, that's fairly common practice to avoid adding to the estate that you're perhaps trying to plan for. Is that also a common route for policies in the US?
Exactly. So there's probably just an extra step, but essentially, for most, I'll describe the scenario, sort of the typical structure, because most of our clients will be US connected individuals, typically living in the UK, so they'll be deemed domiciled if they're not domiciled. So we're looking to take consideration of both the US and the UK rules. So typically what you would have is a US trust, usually what's known as an ILIT, an irrevocable life insurance trust, drafted by a US attorney, so governed by US law. And you would always have a US resident trustee, which is a requirement typically from the insurance companies. You would then have a UK solicitor just review and sign off that the trust is fit for UK purposes. Essentially, that the death benefit would fall outside of the UK taxable estate as well. We would then design policies so that they fit with UK tax rules, the non-qualifying insurance rules. So, little to no cash value. We would design the premium payments to fall usually out of gifts of normal expenditure of income, so that the funding of the policies, which are essentially premiums being paid to a trust, then to the policy, doesn't incur sort of a 20% tax charge. So it's efficient funding on the way in. And then on the way out, it is an income and estate tax-free solution from both a UK and a US perspective. You've got funds then in a US trust, but it's clean capital, it's a mortality benefit. There's no investment component to it, and that can then be used to settle IHT in the UK, or if it's not all needed, it's there and available for whatever purposes the trustee and family need.
Okay, thanks. And why is it important that US taxpayers have US compliant policies, and what is a US UK compliant arrangement? What does that look like?
So main risks. So as far as the arrangement goes, sort of what I just described there sort of is what it would look like. A US policy from a US domestic insurance company held in a US trust. And then if someone's subject to UK tax, then you would have it signed off from a UK solicitor. That's typically what the arrangement would look like.
Mm.
It's very common for to come across US individuals or US taxpayers over here who have UK policies either through work or they've been provided one from an IFA or someone else. The reality is, if someone has a UK policy that we're all quite familiar with, they have these complementary trusts, they don't cost anything. It works great for UK purposes. The reality is the UK trust doesn't work for US purposes. So that hasn't been as much of an issue for some people who, with a very large US gift and estate tax exemption, currently around $12 million per person, or double that for a married couple. But if anyone is below that, and that's due to be cut probably around half in the coming months if tax reform in the US goes through. 40% of the payout would go into someone's US taxable estate and then be subject to 40% sort of haircut. So it's essentially like the policy is directly owned and not in trust. So that's from just an economics perspective, it's just very, it's not sensible planning. On the other side, there's just increased compliance. So if someone has, anyone who's had to file US tax returns will know it's a pain. It happens every year, and it's just adding to that. There's additional forms for acknowledging that you have foreign trust, which is what a UK policy held in the UK trust would demand. So I think the 3520 and 3520A forms. That there's an extra cost to that, obviously, with your accountants, and possibly greater risk of audit from the IRS. We're now on the radar for putting money into foreign trusts, and it essentially sort of begs the question, why didn't you just use a US policy in the first place?
And perhaps you could give us a flavour of other types of planning involving life assurance, perhaps with UK businesses owning policies, looking at pension planning. What are some of the other kind of strategies for planning? Sure.
So yeah, key one is typically always going to be inheritance tax planning. Everyone knows that. For younger families, they may not have as much of an IHT bill. It'll be survivor benefits planning, which will usually be sort of term insurance whilst people start families, have mortgages, school fees, etc., large liabilities going forward. What we've done quite a lot of over the last 6-12 months, working with a lot of partners of law firms in the UK, we're earning sort of several million a year, has been protecting pension benefits, which is quite an interesting new area of planning that we've gotten into. For a lot of these people, they might have, let's say, 20 million of retirement benefits from when, as an annuity or as equity payout over sort of maybe 10 years after they leave. The adjustment, so that would be based on someone having a single life, let's say, pension or single life annuity. Obviously, there's no protection for their spouse if they die. So typically, people would elect for the joint and survivor sort of option, which would typically provide a 50% benefit to their surviving spouse if they predecease. But of course, in selecting that then reduces the overall amount of the benefit from when you start taking the retirement income. So what a number of sort of planners will typically look at is they'll compare and say, well, is it worth keeping the greater amount of your annuity stream by having the single life option? So don't sort of take a haircut on that of, it might be 10%. And then just look to ensure the amount of that benefit through life insurance. And then that works particularly well if someone then lives, they don't predecease their spouse. And also it leads to having a sizable benefit held in trust, which can be used for any number of needs.
Okay, and what about on the protection side, where there isn't necessarily an investment component to the policy? There's a whole range of different products. Have you seen any changes or trends in that area?
So this probably relates more to So sort of 30,000-foot view, you've got the traditional fixed life insurance, mortality benefit, whole of life, and the US equivalent. And then on the other side, you've got more the sort of investment bonds. We will get involved with the US compliant versions of those, sort of offshore, equivalent of the offshore sort of UK investment bonds, known as private placement life insurance or variable annuities. There has been, I don't think there's been a huge change in the interest for those. They come in sort of waves, often driven by pre-immigration planning is a big one. So clients, if they're moving to the US permanently or temporarily, if they have investments that are not US reporting, so private equity, mutual funds, things that are non-US compliant and known as PFICs, these types of wrappers will reposition their investment portfolios and block quite punitive US tax charges. And they can be used for a few other things, like sort of managing accumulation problems for foreign non-grantor trusts with US beneficiaries. Sometimes you'll have non-Americans. We've seen this a lot actually with East Asian clients. You'll have the matriarch or patriarch, with money and sort of family companies set up, do excellent trust planning. And then typically they'll have lawyers in the UK. Then lo and behold, one of the grandchildren goes to uni in the US. And then all of a sudden, it's sort of, you have to reconsider, what does that mean? And whilst the settlor or the grantor is alive, that doesn't necessarily cause too much problem. But when the settlor dies, it then changes the nature of that entity. It's a foreign non-grantor trust with a US resident beneficiary. And there are all these rules around having to distribute income, each year. If you don't, there's interest charges, and it can become quite punitive quickly. That type of offshore US compliant offshore bond planning, there, from a sheer volume perspective, we do a lot less of that, but the cases then are sort of much larger. That's typically driven by a change in someone's circumstance versus people always have a need for IHT planning, etc.
Well, thanks for talking to me today, Christiaan. We look forward to sharing this with our members.